Hi, today we're going to talk about cash flow forecasting and liquidity management. And we need to ensure that your company never runs out of options, and that is a deeper dive that we're going to go into. One of the most fundamental responsibility of any CFO is to ensure that the company always has the cash it needs. You can survive bad quarters, yes. You can survive strategic missteps. You can even survive losing key customers or execs. But you cannot survive running out of cash. When the bank account is empty and the bills are due, well, the game is likely over. Cash flow forecasting and liquidity management are the disciplines that prevent this outcome. They allow you to see around the corners, to anticipate needs before they become crisis, and to maintain the financial flexibility that keeps your company in control of its own destiny. So let me begin. Let me begin with a distinction that matters enormously but is often overlooked. There's a difference. There's a difference between being profitable and being liquid. Profitability means your revenues are exceeding your expenses over time. Liquidity, on the other hand, it means that you have cash available right now to meet your obligations. A company can be highly profitable on paper while simultaneously unable to make payroll, and this happens more often than you might think. And it is almost always preventable with proper cash flow forecasting. The heart of cash flow forecasting is a 13-week cash flow forecast. This has become something of an industry standard, by the way, and for good reason. 13 weeks, or roughly one quarter, is long enough to see meaningful patterns and anticipate those significant events, but short enough to forecast with a reasonable degree of accuracy. So it's a sweet spot between too much detail and too much uncertainty. So let me walk you through how a 13-week cash flow forecast works. You begin with your current cash position, the actual money that is sitting in all of your bank accounts as of today. And then week by week, you project all the cash that you expect to receive and all the cash that you expect to pay out. It's that simple. But the devil is in the details. The difference between those inflows and those outflows, they give you the change in cash for each week. Add that change to your starting position and there you have it. You have your projected ending cash balance week by week, leading to the projected ending cash balance. And this sounds straightforward. And like I said, the devil is in the details. Cash inflows come from many sources: customer payments and receivables, new sales paid immediately, let's say interest income, asset sales, loan proceeds, equity investments. On the other hand, you have cash outflows, and they could be varied as well. You have to pay the suppliers, payroll, benefits, rent, utilities, loan payments, tax payments. You might have to have capital expenditures, dividends. Each of these must be estimated with care. And the key to accurate forecasting is understanding the timing of the cash movements, not just the amounts. So consider customer payments. Your accounting system might show a sale in week 1, but if your payment terms are 30 days, the cash will not arrive until week 5 or 6. And that assumes that the customer pays on time. And many do not. Your forecast must account for this lag and for the historical patterns of how quickly different customers actually pay. You need to figure that out. Similarly, on the outflow side, timing is everything. Payroll might hit every 2 weeks on a fixed schedule, but supplier payments, they depend on invoice dates and payment terms. Tax payments, tax payments come quarterly. Insurance premiums might be annual. Rent is monthly. A forecast that ignores these rhythms will be dangerously wrong. So I recommend building your forecast from the bottom up, starting with what you know with certainty and layering in estimates of where it is needed. Cash is needed. You know exactly when payroll will be processed and how much it will be. Kind of when your lease payments are due. Not kind of, you know exactly when your lease payments are due. You know your scheduled loan payments. Those are pretty much fixed. Start with these fixed, predictable items as your foundation. Then you can add the items that are certain in amount but variable in timing. You know roughly what your supplier payments are going to be based on what your outstanding payables are on your AP aging. The exact timing depends on when invoices are arriving and when you choose to pay them. You know approximately what customer payments will come based on outstanding receivables, but the collection timing might vary. And finally, you add all of these items that are uncertain in both amount and timing, and these might also include potential new sales, possible early payments from customers, discretionary spending that could be accelerated or deferred. Be conservative here. I mean, the idea is to be conservative, not to be aggressive, keep some cushion. Keep a margin of safety. Assume sales come in later and lower than hoped. Assume customers pay slower. Assume costs arrive sooner. A forecast that errs on the side of caution, it rarely gets you in trouble. An optimistic forecast can be fatal. Now, once you have built your base forecast, the real value comes from the scenario planning around it. Your base case represents your best estimate of what might happen, but reality rarely matches those estimates perfectly. So what do? You need to understand. You need to understand what happens if things go wrong and what happens if they go better than expected. Both sides of the spectrum. So what do? You develop at least 3 scenarios. You develop a base case scenario, a downside, and an upside case scenario. The downside case should answer the simple question, what if our key assumptions prove too optimistic? What if sales come in 15 or 20% below plan? What if a major customer delays payment by 30 days or 60 days? What if we face an unexpected expense? Then how does our cash position look? The flip side, you look at the upside case, and that is just as equally important. And people neglect that, but you need to consider that. What if demand exceeds expectation? Will we have the working capital to fund the accelerated growth? Can we take advantage of opportunities if they arise? Companies sometimes fail not because of bad news, but because they cannot fund unexpected success. Scenario planning, it reveals your vulnerabilities and informs your liquidity strategy. If your downside case shows that you're running short of cash in week 8, you need to act now, not in week 7. You might arrange a line of credit, you might accelerate collections, and you might defer discretionary spending, or you might decide to take other measures. The forecast gives you the time to respond thoughtfully rather than desperately. And this brings us to liquidity management, the broader discipline of ensuring that you always have access to the cash that you need. A 13-week forecast is essential, but it is only one tool in a comprehensive liquidity management framework. The foundation of liquidity management is maintaining the appropriate liquidity buffers. And a liquidity buffer is simply cash or near cash assets that are held specifically to absorb unexpected needs. And how large should the buffer be? And there is no universal answer, but there are principles that can be laid out to guide you. You should consider things like your cash flow volatility. Companies with highly predictable cash flows, think utilities or subscription businesses, they can operate with thinner buffers. However, imagine companies with very volatile cash flows. They think of it like seasonal retailers or project-based businesses. They need a little bit of larger margin of safety, larger cushions. The more uncertainty in your cash flows, the more buffer you require. Consider your access to external financing. If you have committed credit facilities that you can draw on quickly, these provide a form of liquidity backup. But remember that credit facilities sometimes disappear exactly when you need them the most. Now, banks have been known to reduce or cancel lines during economic downturns, precisely when the customers need the credit lines the most. Do not count entirely on external sources that you cannot control. Now consider your fixed obligations. A company with very heavy debt service and very large fixed costs, they need more liquidity than one with flexible cost structures and minimal debt. And when revenues decline, fixed costs keep marching on. That's the reality. Your buffer must be sufficient to cover those obligations during reasonable stress scenarios. A common guideline is to maintain cash or available credit equal to 2 to 3 months of operating expenses. But that is only a starting point. It's not a rule. Some companies are prudent. They maintain 6 months to 9 months of operating cash to cover their operating expenses, assuming that they don't get any revenue. Others with extraordinary cash flow predictability and robust credit access, they operate comfortably with a lot less. The right answer depends on your specific circumstances and your tolerance for risk. Beyond buffers, effective liquidity management, it requires diversified sources of liquidity. Do not rely on a single bank or a single type of financing. Maintain relationships with multiple banks. Have more than one type of credit facility available. Understand that your options for asset-based financing, factoring, or for that matter, other alternative sources need to be considered. When you need liquidity urgently, you want to have as much choices laid out as possible. I have seen companies, they survive crisis because they have cultivated relationships with alternative lenders years before they needed them. I have seen others fail because their only liquidity source dried up and they had no alternatives. The time to build these relationships is when you do not need them, not when you are desperate. Let me share some practical wisdom about cash flow forecasting that comes from experience. First, you want to update your forecast regularly, weekly at a minimum during normal times, daily during periods of stress. A forecast is only useful if it reflects current reality. Stale forecasts are worse and useless. They will give you false confidence, and that's dangerous, especially when it comes to cash. Second, track your forecast accuracy over time. Compare what you predicted to what actually happened. Where were you wrong? Were you consistently optimistic about your collections? Did you underestimate certain expenses? And this retrospective analysis, it improves future forecasts and it reveals blind spots in your process. Third, involve the right people. Cash flow forecasting requires the input from across various other partners in the organization. Your sales team knows which deals are likely to close and when. Your operations team knows about upcoming capital needs or unusual expenses. Your procurement team, they will know about large supplier payments that are coming due. The finance team can then build a model. They can have the inputs coming from these different partners and they input that into the model to kind of discern what the cash flow patterns are going to be. Fourth, you communicate openly with your board and leadership team. Cash position and liquidity should be regular topics in management and board discussions. Surprises about cash are among the most damaging kinds of surprises. And if your forecast shows potential concerns, raise them early. Boards and leadership teams can help solve problems they know about. They cannot help with problems hidden from them. Fifth, remember that cash flow forecasting is not just about avoiding disaster. It's also about optimizing returns. Cash that is sitting idle in a checking account earning little or nothing, well, that's a problem. If your forecast is showing that you'll have excess cash in the next several weeks, well, you might decide to invest some of it in short-term investments and earn a return. If your forecast is showing that you'll be drawing on certain credit lines, you can plan to minimize interest costs by timing the draws and payments strategically. So I want to address a question that often comes up, right? It's very frequent. How does this relate to the cash flow statement in our financial reports? And the answer is that they serve different purposes, not two, but different purposes. Your financial statement cash flow is backward looking, remember. It tells you what happened last quarter, last year. Your 13-week cash flow forecast is forward looking. It tells you what you're going to expect to happen and it kind of helps you to prepare for your cash position. Both are important, but they're different tools for different jobs. Let me close with a broader perspective, if you will, on why this matters. Cash flow forecasting and liquidity management are ultimately about maintaining control and preserving the options. And when you have adequate liquidity, you make decisions from a position of strength. You can negotiate better terms with suppliers because you can afford to pay promptly, or you can afford to walk away. You can invest in opportunities when they arise. You can weather the downturns without panic. And when liquidity is tight, everything changes. You make decisions from desperation. You accept unfavorable terms. Why? Because you have no choice. You pass on opportunities that could transform your business. You lay off talented people you'll struggle to replace later on. Cash constraints ripple through every aspect of the operation. Hence, the CFO who masters cash flow forecasting and liquidity management They provide something invaluable to their organization: the ability to control its own fate. In my experience, this capability matters more than almost anything else in corporate finance. Build the systems, develop the discipline, and maintain the vigilance. Your company's future will depend on it. Thank you for attending this session, and thank you for your time. I hope that you found this session helpful. We'll move on to the next one. And again, there are a lot of great videos on corporate finance coming up, and I hope you'll enjoy all of them. Take care. Bye-bye.